Welcome all to today's webinar. My name's Clark Jarrold. Earlier this year, when we were planning to present our financial reporting seminar, we were expecting to be mainly discussing changes in accounting standards. We will still be doing that. However, over the recent months, as we're all aware, the COVID has had significant impact on the economy, and as a result of that, there are significant accounting impacts that we need to address this reporting season. So our agenda today will be to cover these COVID accounting impacts, and on this slide you can see that we'll be covering impairment, lease rental concessions, accounting for government assistance. Primarily we'll be looking at JobKeeper there, going concern issues, some aspects for financial instruments that we'll need to consider, and a couple of other things as well. Finally, we'll have a look at the new key accounting standards for not-for-profit entities, covering revenue, income, and leases. I'm joined today by my colleague, Anthony Whyte, to discuss these matters. Welcome, Anthony.
Thanks for that, Clark. And I might just mention too that if there are any questions as we go through this presentation, certainly feel free to post those, and if we have time at the end, we'll try and get to some of those. Okay, so obviously the coronavirus outbreak doesn't need too much explanation. Everybody's well aware of it and probably well over it by now. But it certainly, from a financial reporting point of view, does have a significant impact on the 30 June accounts. Obviously, businesses, not-for-profit businesses, have been significantly impacted by the coronavirus. Fundraising activities have certainly been hampered for a lot of organisations. Some organisations have had to shut their clubs or their retail outlets that they use to raise funds. Plus, there's been the renegotiation of leases and obviously government support that's provided. Probably also worth recognising too that it's not all necessarily negative. I know for a number of not-for-profit organisations, particularly in the community services sector, it's actually led to an increase in demand on their services and probably will keep doing so going forward. So obviously there's a significant impact on different elements of the financials, and that's what we're going to go through now. So the first area that we'll look at is impairment of assets. Now, for not-for-profit organisations, assets that you would mainly think about under the impairment heading would be financial assets, inventories, property, plant and equipment, and other assets. So, and what preparers of the accounts will need to consider is the impairment standard AASB 136. Will that be applicable, and what will be the thinking process in applying that in this year's accounts? From discussions I've had to date with many of my not-for-profit clients, the big item in this space is their properties and potential impairment of properties. And so we'll talk a little bit about that as we go through this issue of impairment. So when is AASB 136 applicable? I suppose it's easily summarised by saying that if the assets that you hold are subject to regular revaluations to fair value because you adopt a revaluation model, then you're not necessarily thinking about AASB 136. You don't fall under that. But where you've got assets, property, plant and equipment or intangibles, and it's accounted for under a cost model, then you certainly do need to think about the application of AASB 136.
Anthony, you've said that it may not apply, those 136, where certain property, plant and equipment is regularly revalued to fair value. Can I rely on my 2018 or 2019 valuations this year to argue that AASB 136 does not apply to my relevant assets as at 30 June 20.
No, definitely not, Clark. So I think obviously a lot of people have obviously heard in the media, and we see it all the time, how has this affected property values and the negative impact it's having on the economy. So when even under a revaluation model, even though you might be operating, say, on a 3-year cycle and you did your last revaluation in 18 or 19, when it comes to do your 30 June 2020 accounts, you still do need to consider, does the value that you have recorded in your accounts reflect fair value? And I think there's a significant risk that fair values will have gone down given the impacts of COVID-19 on the economy. So even under the fair value model, preparers of the accounts will certainly be looking at that, have that on mind. Okay, so what are the impairment testing requirements under AASB 136? Quite simple. If you have goodwill or indefinite life intangible assets, then you're required to test for impairment each year, and certainly if there's an indicator of impairment as well. For other non-financial assets, so property, plant and equipment and right of use assets, the standard requires that impairment testing is to be performed when there's an indicator of impairment. So what would be an indicator of impairment? Well, the standard talks about external sources of information and internal sources of information. External sources would be if there's observable indications that asset values have declined, or if there's significant changes in the economic or legal environment. Now, just on those 2 points in particular, I think it's pretty clear that there is evidence coming through of drops in property values, and there's evidence coming through of negative impacts on the economic environment. So I think it's easy probably to reach the conclusion that there are those external sources of information this year that do suggest that there is an impairment indicator, and hence management in preparing their accounts will need to consider that, document their considerations around that, and perform their impairment testing. One point that I will mention here as well is that, as I said before, property for not-for-profits is one of the main assets that is often considered under this heading, particularly where it's recorded at cost. And when considering the external sources of information and whatnot, taking into account how long you've held the property for is relevant as well. I know in the discussions that we've been having with clients, property that you've held for 20 years, there may not be such a risk of impairment as opposed to, say, something that you've acquired in the last 24 months or so. So that's all relevant considerations. So testing for whether there's an impairment loss. Obviously, there's a loss if the recoverable amount is less than the carrying value. To determine that recoverable amount, you'll either determine the fair value, less cost of disposal, if you're able to determine the fair value, or a value in use. So going back to our buildings example, often it will be a fair value. But value in use might be relevant if that asset generates its own independent cash flows. So thinking, for example, aged care facilities, clubs, childcare facilities, value in use might be relevant in those situations. Okay, when we're looking at value in use, we estimate, we go through the following steps. We estimate what the future cash inflows and outflows to be derived from the continuing use of the asset and from its ultimate disposal. And then we also estimate an appropriate discount rate to reflect the risk in relation to those cash flows. Now, if we just go over the page, in a normal economic environment, maybe a single set of cash flows is sufficient when determining value in use, when doing your discounted cash flow model, as you'll be able to reflect the risk through the discount rate. But in these uncertain times, and to be honest, I'm sick of hearing that, but they are uncertain times, maybe a single set of cash flows won't be sufficient, and it might be more appropriate to consider multiple cash flows and then weight those with probability of the likelihood of those cash flows. Just to explain that a little bit further, I suppose this graph in a rough way does demonstrate that. So in this particular example, there have been 4 cash flow scenarios forecast. A positive case, base case, negative case, and obviously a worst case. So an entity that might have these 4 scenarios that allocate a probability against each of those cash flows to then arise at a fair value.
So Anthony, I see there on this graph we have 4 scenarios. Will it always be the case that there will be 4?
No, definitely not, Clark. 4 is not the magic number here, and it comes down to individual circumstances. I know for our December reporting, and when we were looking at cash flows for going concern purposes, which I will touch on later, it actually wasn't that unusual to see organisations have 7 or so cash flow forecasts taking into account different factors. So, and it could be less than 4 as well. What is interesting is that worst case scenario, and certainly when we talk about going concern, I'll mention that worst case scenario a bit more. Okay, Clark, so can you just explain how changes in the value in use calculations given the introduction of AASB 16?
Certainly, Anthony. So we've all been used to historically accounting for operating leases under the old AASB 117 standard. Under that standard, operating leases were not recognised on balance sheet. So there's no asset included in the carrying value of the cash generating unit that we were testing. The payments for those operating leases were included in the cash outflows that were used to generate the net cash flows for the value in use calculation. Under AASB 16, of course, we recognise a right of use asset. So if we think of leases of premises, we now recognise the right of use asset on the balance sheet, whereas in the past we didn't. So the carrying value of the cash generating unit assets, which are tested for impairment, are going to be higher. Matching that is the fact that the cash outflows that are used in the value in use calculation will change. The lease payments that are included in the lease measurement are now excluded from the cash outflows in determining the value in use. It's worth noting, though, that the lease payments that are not included in the lease liability measurement, they're still included in the cash outflows in determining the value in use. So as an example of that, if we have lease payments that are contingent based on sales for a retail shop, they are still included in the cash outflows in determining value in use. That is because they're not reflected in the lease liability, nor are they reflected in the right of use asset. Now moving on to lease rental concessions, having just discussed the new accounting standard AASB 16. In the COVID environment where we've seen quite a few shops and such like where they've had to shut down their operations. So the landlords have been offering concessions to tenants, or they've been negotiating concessions in recent months to compensate for the COVID-19 disruptions. An issue is how to account for those concessions. That has come up in recent times. Many concessions would be a lease modification under AASB 16. We would find that is because the concessions would not have been considered in the original lease terms, and so we would have to adopt modification accounting if they were to be considered a modification under 16. They weren't reflected in the original lease terms. Modification accounting includes remeasuring the lease liability based on the revised payments using a revised discount rate. So you may have had an original incremental borrowing rate for a leased property. If you've got a modification as a result of the concession, you have to calculate a new incremental borrowing rate and remeasure the lease liability using that revised rate and the revised payments. That will also result in a reduction of the right of use asset. An effect of this is that the accounting for the effect of the concession is over time, not at the time the concession is granted. So that'll be reflected through a reduction in the depreciation of the right of use asset and reflected through interest payments over time. As a result of that, it would be many entities would find it challenging to deal with rent concessions. Think of entities that have got hundreds or thousands of leases, even entities with scores of leases, having to go through each lease to work out whether the concession was within the existing lease terms or not, and therefore whether the entity had to apply modification accounting. That would be challenging, to say the least. So the International Accounting Standards Board and the AASB have moved faster than I think I've ever seen them move in changing accounting standards. So the IASB amended AASB 16 in May this year. So if you think COVID only started a couple of months earlier than that, to provide lessees with an exemption from the requirement to determine whether a COVID-related rent concession is a lease modification. So you can, under this amendment, not have to go through each lease to determine whether the concession is a modification or not. And if you take that amendment, you apply accounting as if it's not a modification. To be able to apply this exemption or this practical expedient, the IASB introduced 4 criteria that you have to assess. They are shown on this slide. So the first criteria is, did the rent concession occur as a result of COVID-19? Does the change in the revised lease payments result in a consideration for the lease that is substantially the same as or less than the consideration for the lease immediately prior to the change? Does the reduction in lease payments affect only payments originally due on or before 30 June 21? The idea here being that the concession has to be related to the effects of COVID. And then finally, is there no other substantive change in the terms and conditions of the lease? Now, if you meet all these criteria, you can adopt the practical expedient and therefore not have to apply modification accounting. If you fail to meet those criteria, then you've got to go through the lease and determine whether or not it's a modification. And if it is a modification, then you apply modification accounting. And remember, that's using a revised discount rate, and the change to the lease liability is reflected as a reduction in the right of use asset accounted for over time. Now, just as an example of applying this practical expedient, on this slide we have this scenario. So we've got $100 in lease payments per month for 20 years starting July 19. In April 2020, the lessor and lessee agree on that date to a 6-month rent concession for the period of April 20 to September 20. If the lessee determines that it meets the criteria which I've just run through and wants to apply the practical expedient, then the lessee will recalculate the lease liability based on the new lease payments as agreed, In other words, here in this scenario, just taking out 6 months of payments, using the original borrowing rate that was used in the original lease, and they'll update the lease liability calculation. So the liability as calculated under the revised terms will be compared to the existing liability, and the reduction in the liability will be recognised immediately in profit and loss. The important point there is there's no change to the discount rate and no change to the right of use asset. So the impact of the concession is recognised immediately in profit and loss, and it's a much easier process than if you have to apply modification accounting.
So Clark, are rent concessions always accounted for per this exam?
It's not the case that this example is how it'll be accounted for in all cases. The accounting will depend on a number of issues, such as the type of concession. Is it a deferral? Is it a rental abatement and such like? It will depend on the date the parties agree to the concession. So if there's no agreement prior to 30 June 20, you won't be accounting for a rent concession in the year ending 30 June 20. It also depends on whether the concession is conditional on future events. So as a general comment, a lessee merely not paying rent because it asserts that a rent concession should be given, that won't be accounted for because there's no agreement. Or if a concession is given whereby the monthly payment is reduced, but only on condition that, say, foot traffic past a shop is reduced by a certain percentage each relevant month, well, that likely will be recorded each month as that condition is met. So what you will need to do for the concessions that you do negotiate, you'll have to carefully assess the nature of each concession and determine the appropriate accounting.
Excellent. Okay, we'll now talk about government assistance, and there have been obviously a lot of government assistance packages, but we have been asked by a number of clients about how to account for JobKeeper. So we will focus on JobKeeper in particular. I'll just point out for-profit entities, the relevant standard that they refer to here is AASB 120, accounting for government grants and disclosure of government assistance. Now under that, you recognise the receivable for JobKeeper when there's reasonable assurance that the employer will comply with the conditions attaching to the grant, so therefore must be an eligible employer and must have paid the employees the 1,500, and also reasonable assurance that the grant will be received. Under AASB 120, for-profit entities are allowed to present the grant income gross or on a net basis, depending on what their accounting policy is. Now, for yourselves as not-for-profit entities, that's interesting, but AASB 1058 really is the standard that's going to dictate how yourselves account for JobKeeper. So we'll talk about sufficiently specific performance obligations more generally when we talk about the new revenue standard, but there are no sufficiently specific performance obligations when it comes to the receiving JobKeeper. So that's why it falls under 1058. Now, the recognition criteria are similar to what we talked about on the previous slide for-profit entities. The main difference for not-for-profits under 1058 is that not-for-profit entities are not permitted to offset the receipt of JobKeeper and the payment to employees. So it is disclosed on a gross basis under 1058. So going concern is the next thing we'll talk about, and over the last 3 or 4 months, this has been an area where on each of our audits, whether for-profit or not-for-profit, we have spent a lot more time than in previous years, given COVID-19. At the end of the day, it's management's responsibility to determine whether an entity is a going concern. So when financial statements are prepared, management make an assessment of the entity's ability to continue as a going concern. And that's to consider whether for 12 months out from the reporting date that the organisation will be able to pay their debts as and when they fall due. Now, I will point out from an audit point of view, because you'll realise that your auditors often come to you and actually ask for forecasts 12 months out from the expected signing date of the accounts. The audit standards are a little bit different and requires going concern to be considered for 12 months out from the date of signing the accounts. So I'm sure you'll all have those 12 months forecasts ready for the auditors when they arrive. I also just mentioned too here, going concern is different to solvency. So obviously your board members would be very conscious and yourselves would be very conscious of solvency, and you do still need to consider whether you can currently meet your debts as and when they fall due, and you're not incurring debts that you're not able to pay. So that is a separate issue. So the effects of COVID-19 obviously affect the level of uncertainty around going concern. Obviously, a lot of organisations have had to put on hold their fundraising events, which they rely on. They've been unable to provide goods or services, as I mentioned before, had to shut their retail outlets, and maybe even a question mark over whether the government funding that they've received historically is secure, or whether they'll have to repay some of that government funding because they were unable to deliver the services that funding was for during the shutdown period. So there's a lot of things to consider there. Where there is significant uncertainty around the outcome of future events, it'll be appropriate to model multiple scenarios and weigh up their likelihood, similar to when we were talking about the value in use calculation. And I do suggest in that with the multiple scenarios that there definitely is a worst case scenario, but I think most organisations do that. So some of the assumptions that might be considered when determining those cash flows is liquidity and where funds can be obtained from if needed, compliance with covenants if you do have borrowings or contractual agreements, funding agreements, forecast of the future revenue, especially where you're not able to run your fundraising activities, or you're an arts organisation and you're not able to run your performances, and assumptions around the length of time and severity of this disruption. Also, what would be factored into it as well is the level of government support, and I think everyone is talking about this cliff in September when JobKeeper stops, or is forecast to stop at the moment, and what impact that will have. You'll also consider whether there are any mitigating factors around going concern that offset those matters. So what that leads to, and the consideration of all those assumptions, is, well, what impact does that have then on the financial report? And I'd probably just draw your attention to the coloured boxes in this flow chart rather than the grey boxes. I'll talk about the aqua box up the top to start with. So that's where there is no uncertainty around going concern. It's clear you've got sufficient resources to be able to continue, or your operations aren't that negatively impacted. So you continue to prepare your financial reports on a going concern basis. I will come back to that box in a minute, but I'll then jump down to the blue box at the bottom. Another scenario might be that there are indicators that there are events or conditions that might cast significant doubt over the ability to continue as a going concern. But when you work through those indicators, you arrive at the conclusion, well, there is no material uncertainty. Therefore, you prepare your accounts on a going concern basis, and you include disclosure in your accounts about those judgments that you made around those indicators. Now, I hope most organisations fall within that aqua and blue box in this reporting period. You may find yourself in the orange box where there are indicators of impairment, lack of ability to continue as a going concern, significant uncertainty around when fundraising might restart again, and that's what you're really relying on, or when you can start to run your events again. Therefore, if there's that significant uncertainty, you provide that disclosure in the accounts, and you provide disclosure why management think it is still appropriate to prepare accounts on a going concern basis. When you're in that orange box, your auditors will include additional disclosure in their audit report, drawing attention to that. Hopefully no one ends up in the red box. That's where we say, well, going concern basis isn't appropriate. I'll just quickly jump back up to that aqua box where it does say, consider disclosing the effects of COVID-19 as it is best practice. Now, ASIC certainly has put out guidance, as has the AASB, indicating that some commentary around the impact of COVID-19 and why it is still appropriate to prepare accounts on a going concern basis is appropriate, because users will just be wondering about that. So I'd imagine most organisations will have some disclosure in their accounts about that.
Thank you, Anthony. We'll now just look at financial instruments and a number of issues there. So first of all, financial liabilities and modifications. In the current environment, many entities may have loans such as bank loans and other forms of finance, and may find, because of the circumstances, they have to be modified. Those modifications could take a number of forms, for example, extension of the contractual maturity of the loans, or modifications to payment terms. So if you do have financial liabilities that are modified, then AASB 9 has certain requirements as to the impacts of these modifications. What the standard requires is an assessment as to whether the modification is substantial or non-substantial. If a modification is considered substantial, then we do recognise the existing liability and recognise a new liability at fair value. Of course, the fair value of the new liability will reflect circumstances at the date of the recognition of that new liability, for example, the interest rates at that date, etc. If a modification is considered non-substantial, the carrying amount of the existing liability is adjusted to reflect the present value of the revised cash flow payments, but that is done at a discount rate that is the original effective interest rate for the liability. So that's the difference between substantial and non-substantial. The difference in both cases is recognised in profit and loss. Now, the standard gives some guidance in determining whether a modification is substantial. In particular, there's a focus on the difference between the present value of the revised cash flows and the carrying amount of the existing liability. That this difference is greater than 10%, then the change is considered substantial. In addition to that, we also look at whether the change in the terms is considered qualitatively different. If it is qualitatively different and considered substantial, then you end up in substantial modification accounting. If it's less than 10% and the changes are not considered substantial qualitatively, then we can account for it on the basis the change is a non-substantial modification. That's a little different from the old AASB 139 days under the previous standard. Accounting for substantial modifications hasn't really changed, but accounting for non-substantial modifications is a little different. So we should focus on that if we have modifications to financial liabilities. We also have under WSB1, under WSB9, I should say, the consideration of impairment of financial assets. The COVID environment may have a significant impact on accounting for expected credit losses. For example, it may have the impact that there's a significant increase in credit risk. Therefore, a particular financial asset may be reclassified from stage 1 under the ECL model, which results in a 12-month expected credit loss, to the financial asset being classified under stage 2 or 3, where you recognise a lifetime expected credit loss. And typically that will be higher than the 12-month expected credit loss. COVID impacts may also increase the risk of default, which is an input into determining the expected credit loss. It may also result in the amount of the credit loss itself being higher due to, for example, debtors taking longer to pay and such like. The assets that we'd be considering here are things like loans at amortised cost or assets at fair value through other comprehensive income, such as certain bond investments. Impairment's also relevant for trade receivables. As we can see on this slide, many entities will adopt a matrix approach for assessing the expected credit loss for trade receivables, using an expected loss rate or default rate based on ageing. Suffice it to say that in a COVID environment, the use of historic loss rates from prior periods may not be relevant anymore. So entities may have to update their loss rates to reflect the current environment. Just looking at a couple of other accounting issues. Anthony mentioned fair value measurement earlier in this discussion. It's important to note that fair value is date specific. So you can see that in the definition of fair value at the bottom of the slide, where it says that fair value is the price that we receive to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So it's important to understand that fair value is date specific. So as a result of that, older valuations, for example, for property, plant, equipment, may be out of date in the current environment. The first dot point on this slide also notes that it may be challenging to estimate fair value in the current environment, but of course we may have to do that even if it is difficult to do so. Another issue is possibly accounting for termination benefits for employees. It's important to understand that the accounting standards have very specific requirements for accounting for termination benefits and the timing of the recognition thereof. So if you are considering recognising termination benefits, you should carefully look and assess the requirements in the accounting standards. So that's a high-level summary of some of the impacts for not-for-profit entities in respect of COVID-19. We'll now just look at some of the key changes for the current reporting season. First of all, we'll look at WSB 16 leases. And we're going to mainly talk about the impact of the new standard for lessees. We're not going to really address lessors, because for most not-for-profit entities, the lessee accounting is what's relevant. I will say that, or note that for lessors, we still have the issue of having to classify leases as operating leases or finance leases. For lessees, we no longer have to do that. For lessees, all leases, except for certain leases, which I'll comment on a little bit later, are now recognised on balance sheet by recognising a right of use asset and a lease liability. So, for example, your property premises which you lease will now be recognised on balance sheet rather than being treated as an operating lease, which is off balance sheet as in the past. This is done by determining the present value of the future lease payments. The lease payments to be capitalised comprise the fixed payments as well as certain variable payments, but not all variable payments. Variable payments are linked to an index such as CPI or a rate such as a market rental are capitalised. Other variable payments, such as variable payments linked to usage, such as turnover-based rentals, they are not included in the capitalised lease payments. Another change is that option periods are dealt with specifically under this new standard, and lessees are required to consider whether option periods are part of the lease term. If it's reasonably certain that you will exercise an option, then that period will be part of the lease term, and the payments during that period will be capitalised. So just as an example on the effect on the primary statements, we've got a simple example here. So we start with the background information. You can see there a lease of an administration building with payments as set out there. You can see on the bottom of this slide the impact on the profit and loss statement. So as you can see, under the old standard, we used to straight line the rental expense, and that was that's 72,000 per annum. Under the new standard, we have interest expense, and that's interest on the lease liability, and we have amortization expense, which is amortization of the right of use asset. Of note there is that under the old standard, the expense was straight line. Under the new standard, the total expenses decline over time. So there's a change in the pattern of recognising expense. The impact on the balance sheet, we can see here on this slide. Operating leases, as I mentioned earlier in this discussion, were previously off balance sheet. Under the new standard, apart from a few exceptions, all leases are now on balance sheet for lessees. So you can see here we've got a right of use asset, and we've got lease liabilities, current and non-current. So you can see by recognising a current liability and no current asset, that significantly changes the ratios in the balance sheet. It's also worth noting that there may be an effect on net assets because it's typical that the lease liabilities may exceed throughout the term of the lease the right of use asset. Finally, looking at the statement of cash flows, the total cash flows, as you can see, stay the same each period, but there's a change in where the cash flows are recognised in the statement of cash flows. Previously, the cash outflows would have been shown within operating cash outflows. However, from now on, cash flows will be shown as partly interest expense, and that could be shown either as financing or operating. There's choice there under the standard 1007 or 107. Then the financing cash flows also include reduction in principal payments. Other considerations under the new standard. I did say that there were some exceptions from having to recognise leases on balance sheet. So those exceptions relate to low value items, and the standard doesn't actually tell you what is considered low value, but in the basis for conclusions to the standard, it mentions an amount of approximately $5,000 US. So we're thinking of things like laptops and the similar items in terms of what are low value items. The other exception is short-term leases, leases of 12 months or less. It's a matter of choice. You can choose not to apply AASB 16 to these items, and instead you can expense them straight line over their term, similar to what you would have done in the past. Other key judgments under AASB 16 relate to the lease term. There's new guidance in the standard for lessees to determine what is the lease term. Where it's reasonably certain that you would exercise an option, that option period will need to be included in the lease term. In assessing that, you consider economic incentives to exercise the option. It's important to note that the longer the lease term, the higher the right of use asset and the higher the lease liability. Another key judgment is the incremental borrowing rate. For certain leases, you may be able to determine the borrowing rate implicit in the lease, and in fact the standard requires use of that implicit rate if you can determine it. But the standard acknowledges that for certain leases you won't be able to determine the incremental borrowing rate. Sorry, you won't be able to determine the implicit rate. Therefore, it says that you should assess the incremental borrowing rate and apply that to determine lease liability and the right of use asset. This is a matter of judgment that many entities will need to come to grips with in applying this new standard. Factors that can impact the incremental borrowing rate are things like the nature of the asset, the term of the lease, the value of the lease, the economic environment, and such like. Finally, I should mention peppercorn leases. Initially, when the standards were amended, it was the case that you had to assess the fair and recognise the fair value of the right of use asset, recognise the lease liability, and the excess of the right of use asset fair value over the lease liability for a peppercorn lease would be recognised as income. The Australian Accounting Standards Board subsequently changed the requirements around peppercorn leases so that you don't have to do that. And the effect of that is that you won't be recognising the income. You can recognise that cost, which means the right of use asset and lease liability would be the same. And for leases at $1 per annum, that would be effectively a nominal amount. That was changed in late 2018. We should continue to monitor that, because when the AASB made that change, it said that the option for lessees to not measure a right of use assets at fair value was only a temporary option. So we'll see how long that lasts for. I should also mention transition as an issue, because this is the year we are transitioning to this new standard. Lessees have a number of choices on transition that they need to address. First of all is what approach you take to transitioning. So this slide sets out the approaches, and you'll notice that there's 3 approaches here: a full retrospective approach, and then 2 approaches under the modified retrospective approach. Our experience is that very few people are adopting the full retrospective approach. Most entities, if not all the entities we've dealt with so far, have adopted the modified retrospective approach. Under the modified approach, you don't adjust your comparatives, and you only account for the effective AASB 16 from 1 July 19 if you're a 30 June balance date entity. Now, under the modified approach, there are 2 alternatives. The lease liability is the same under both approaches, and it represents the future lease payments from 1 July 19, discounted at the incremental borrowing rate at that date. What's different under these 2 approaches is the determination of the right of use asset. Under the modified approach number 1 there, the right of use asset is set to equal the lease liability, apart from any accounted for or accrued lease payments as at 30th of June 19, which are offset against the right of use asset. So there's no effect on opening retained earnings under that modified retrospective approach 1. Under modified approach number 2, the right of use asset is calculated as if you've always applied the standard with some practical expedience and using a incremental borrowing rate at the date of initial application. I should mention that these approaches that I'm talking about here are how to transition for operating leases under the old standard. Of course, finance leases that are accounted for under the old standard, the amount for those is the amount that was recognised under the old standard. You may be considering which method you should adopt. Well, this table here sets out how we see the pros and cons of each method. As you can see, for the full retrospective method, the pros are greater comparability, but there's significant cons there, in particular the cost and the effort required to determine the full retrospective approach entries, and also the effort that's required. We haven't seen anyone adopt the full retrospective approach here in our client base to date. So all our clients seem to be adopting either modified approach 1 or 2. In terms of not-for-profit entities, virtually all of them so far have adopted modified approach number 1, because it's the simplest approach and it costs less. The main con for modified approach number 1 is that the post-transition expenses, and we're talking mainly about depreciation here, are higher than modified approach 2, and that's because the right of use asset under modified approach number 1 is a higher balance on day 1 July 19, as compared to modified approach number 2. So for-profit entities, in some cases, are selecting modified approach number 2, whereas our not-for-profit clients tend to be selecting modified approach number 1 because it's simpler and costs less. Finally, I should just mention accounting systems. If you've only got a handful of leases, then maybe you can get away with accounting for the new accounting standard for leases under AASB 16 by using an Excel-based approach. However, as your number of leases grow, this becomes problematical, and so entities with, as the number of leases grow, are tending to look for some software solution, and that's something similar to our BDO lead software solution, such as BDO Lease Management Services, and that certainly becomes more relevant as the number of leases grow.
Excellent, thanks Clark. I've got 10 minutes to cover the new revenue standard, so that's going to be nice and easy. So we'll get into that. Okay, so I suppose the key, one of the key messages I want to drive here is to highlight that the first process is to determine what standard you're in, whether you're under the revenue standard, AASB 15, or the income standard 1058. And so I really will try and help make that clear for you in case that's not clear already. Now, the core principle behind the revenue standard AASB 15 is that you recognise revenue to depict the transfer of a promised good or service to customers in an amount that reflects the consideration for which the entity expects to be entitled in exchange for those goods or services. So really here, the key point is that you recognise the revenue to depict the transfer of promised goods or services. So there has to be transfer of promised goods or services. Now, we've been talking about the new revenue standard for a while now. So this model, the 5-step model, I'd imagine would be familiar to most of you. So identifying the contract with the customer, identifying the separate performance obligations, and that's where we'll spend a bit of time in a minute because that's the difficult part for not-for-profits. Step 3, determine the transaction price, allocate the transaction price, and then the final step, recognise the revenue when the performance obligation is satisfied. So where applicable, revenue is recognised over time as the performance obligation is satisfied. And I know, to be honest, all not-for-profits want to fall in that bucket and recognise the revenue and match expenses, but as we go through this, obviously that's not always going to be possible. So the key issues that we're addressing here, and I'll just work through this decision tree because it is really fundamental to this. Are the funds received for the purpose of acquiring or constructing an asset? If yes, we'll go straight to 1058, and we'll talk about that in a minute. If it's no, does the transaction occur in a contract with the customer that creates enforceable rights and obligations? If it doesn't, we're in 1058, and I'll talk a little bit in a minute about what's enforceable rights and obligations. If it does the contract include sufficiently specific performance obligations? And if it doesn't, we're in 1058. So I'll just unpack a little bit more then about whether there's a contract with enforceable rights and the sufficiently specific performance obligations. So I think most cases are relatively straightforward when it comes to determining is there an enforceable agreement. They'll either be, particularly for not-for-profits, a legal or some other kind of structure. If it requires a refund of the cash that is being provided, then it's most likely there's an enforceable agreement. So clearly with grant funding and clauses in there, if you don't meet certain requirements and the funding has to be returned, well, there's an enforceable agreement. When you receive a donation, typically that's not enforceable. There's no requirement to refund the donation. So you go to 1058 for that. So whether there's an enforceable agreement is normally relatively straightforward. What is less straightforward is whether the performance obligations are sufficiently specific. So a necessary condition of identifying a performance obligation of an NFP is that the promise to transfer goods or services is sufficiently specific to be able to determine when that obligation is satisfied. Now, I'll just go through this high-level summary to draw out a few different examples. So I'll look at the blue box first. If the funding is received to fund an internal activity, then there is no transfer of goods or services in that instance. So you're in 1058. There's no specific performance obligation to transfer goods or services. If you're in the orange box, you might receive income that is specified to go towards your vision or your goals. So it might be to improve living conditions of people in poverty or whatever, quite a broad purpose. So it's to achieve an outcome. Again, there's no specific transfer of goods or services connected to receiving that revenue. So you're in 1058. If the revenue is received to provide outputs, so to provide goods or services to customers, and it's sufficiently specific in what those goods or services to be provided are, then you're in 15 and you work with that for determining when you recognise revenue. So really, I'll drive this point home. Not-for-profits should be reviewing their grant and similar agreements to assess appropriate accounting under the new standards. It's really important that you are looking at those agreements and analysing those. Pardon me. That was it. Okay, so we'll go through an example here to help demonstrate. So an alumnus transferred 2 million cash to University A as an endowment under the terms of the endowment. The 2 million cash can be invested at the university's discretion. If the university breaches the terms of the endowment, the university is required to return the real value of the principal to the alumnus. University A is required to provide free student accommodation each year for one student for 1 year, for as long as the University A continues to operate as a university and subject to the real value of the principal 2 million being preserved. Income generated from the investment of the principal may be applied to provide student accommodation, and any excess income from the investment can be spent on other university activities. Now, working through the assessment of this, based on the facts there, on gaining control of the endowment of 2 million, University A determines that there are no related amounts for the 2 million, as the endowment does not give rise to a contribution by owners, a contract with a customer within the scope of 15. And this bullet point here is really the key bullet point. While the promise to provide student accommodation is distinct, and the university can identify at the end of each year whether or not it has delivered the accommodation to one student, it cannot identify when its obligation is fully satisfied and cannot allocate the transaction price, as the promise is continuous as long as University A continues to operate the university. Therefore, University A must be able to identify when the performance obligation is satisfied for the promise to be identified as sufficiently specific. Okay, so we're in 1058 in this circumstance, and the 2 million is recognised as income when it's received. Okay, a couple of quite good scenarios here, which we will work through. So Mr. Rich grew up in a very imaginative name, grew up in a home where he experienced domestic violence and donates 1 million to crisis charity to be used over the next 3 years. The objective of the charity is noted in the charter as being the provision of crisis counselling services to those in need. So I've got a couple of different scenarios here, and we'll use these to illustrate what is sufficiently specific. So under scenario 1, the funding is provided to be used in accordance with the charter, and that's all there is. So we'll jump down to the assessment of that. There is no enforceable agreement. There's no mention of having to repay the funds, and the deliverables are not sufficiently specific. There's no clear reference to goods or services to be delivered under that scenario. If we look at scenario 2, it's to be used for the hiring of social workers to review crisis charities programs and advise management on improvements. The donation cannot be used for any other purpose, and any unspent or misused funds will be returned to the donor. So yes, we do have an enforceable obligation. The funds do have to be returned if they're not spent, but the outputs are not defined. The hiring of social workers for the stated purpose is an internal activity and does not lead to the transfer of goods or services to a customer. Therefore, there's not sufficiently specific performance obligations, and you're under 1058. Under the final scenario, the money is provided to provide 80 hours of crisis counselling to the public per week for a 3-year period, and cannot be used for any other purpose and has to be returned if it is. So yes, there's an enforceable right, but it clearly defines the outputs, the goods or services that need to be delivered. So you'd say in that instance, it's sufficiently specific and you're under 15. Okay, so similar to the leases, there's a couple of options with the transitioning. Because we are running out of time, I won't go through this in any detail. It's full retrospective or a more simplified cumulative effect where you just adjust your opening retained earnings. And to be honest, we're seeing a lot of clients do more of the simple cumulative effect method. Okay, 1058. So as you're all probably aware, 1058 does talk about the recognition of volunteer services, which I will talk about briefly, but also where the consideration to acquire an asset is significantly less than the fair value of what's received and the accounting in those instances. So volunteer services, if you can fair value it, then that's good, but you still have a choice as to whether you recognise those services or not. And certain government entities do have to recognise volunteer services in certain circumstances, so there's no out for government entities. Transactions other than volunteer services. So if the transfer of the asset to the not-for-profit is to enable the not-for-profit to acquire or construct a recognisable non-financial asset to be controlled by it, if that is the case, then you recognise the income as you satisfy the obligation for the transfer of that asset to yourselves. And we'll go through an example of that in a minute. And if not, basically recognised when received. So an example of where money is received to construct an asset. So in this example, the government donates $2 million to build an early learning centre, and the agreement is for the school to construct the early learning centre, return any unspent money, and reimburse the government if it ceases to run that early learning centre in the next 10 years. So School A basically determines, I'll jump basically to the bottom bullet point, this is the most relevant point. So in accordance with 1058, School A recognises the grant initially as a liability when it gets control of the funds, and then as those funds are spent constructing the building, it recognises it as income at that point in time. And I suppose this is the pain point for some not-for-profits, because they are recognising the grant income for that capital asset up front, but they're incurring a cost over the longer term as that depreciates. And unfortunately, that is just the way the standard works. And that's what these journal entries reflect. So over the first 2 years, you're recognising that income. Okay, I won't go through this in any detail. Other transactions that fall under 1058 donations we've talked about. So I think hopefully I've made it clear as to how you determine what standard you fall under.
So Anthony, are there any other key issues that our clients should consider this reporting season that we haven't covered so far?
Yeah, there are, and there are also some issues that I think clients just need to keep in mind what's coming up, and I'll just go through these really quickly. So most of you probably would have heard that legislation was passed mid-June for portable long service leave to be introduced for the community services sector. So I expect that that will come into place over the coming 12 months. And please refer to our website where we've posted some more information about that portable long service leave coming into place. Again, the politicians were very busy in June. They passed another piece of legislation around the Association Incorporation Act, which I think over the coming 12 months will align the reporting under that Act to the reporting requirements of the ACNC, where an association is also registered with the ACNC. So again, watch out for detail on that as the regulations come into place. For this year's financial reporting, there is an issue for those that prepare special purpose financial reports in the not-for-profit space. There have been changes made to AASB 1054 that will require additional disclosure in those special purpose accounts explaining why special purpose was adopted as opposed to general purpose, and some additional disclosure where measurement or recognition requirements may differ to what the accounting standards require. Now, what this, I think, is all leading to and ties in with the review of the ACNC legislation, which has been going on for a little while. So the government, when we all locked ourselves down for COVID, the government actually come out and said it agreed with the findings from the review of the ACNC legislation, or many of the findings. What I think that will see happen over the next 12 months is an increase in the reporting thresholds under ACNC. So what was muted was large would be now revenue greater than 5 million and medium revenue between 1 million and 5 million. So those thresholds are increasing. More detailed related party disclosure. Where I think this is all heading, and these are just my thoughts around this, ultimately there is going to be a scrapping of special purpose financial reports for not-for-profits. And I know there are some not-for-profits out there that do special purpose and don't adopt the consolidation standard, and I think they're going to be the ones that are going to be watching this most closely.
Thanks, Anthony. So we've had a couple of questions come in. Just choose a couple of them. So first of all, we've had one as to whether a not-for-profit entity can defer income to match it with expected future costs that relate to that income. Can that be done?
That's a good question. Look, the new standards require a not-for-profit entity to assess which income standard applies, i.e. whether it's 15 or 1058. If 15 applies, then it may be the case that revenue is deferred and recognised over time as performance obligations are satisfied. However, if 1058 is a standard to be applied for recognising income, then it cannot be deferred except in the case of, say, a capital grant, which we discussed just a minute ago.
Okay, another question here about the new income standards. This question is, what do you expect your client to give you as an auditor rating revenue recognition this year?
I love that question. So probably from an ex-auditor, I'd say. So assume that question relates to the new income standard and what do we expect to receive in relation to this. We've already worked with a lot of clients on this for the 31 December 19 reporting. Primarily what we need is an accounting position paper that explains for each income stream the relevant accounting standard and the basis for supporting that conclusion. For revenue that's to be accounted for under AASB 15, this includes identifying the sufficiently specific performance obligations. So I think that needs to be done on a contract by contract basis. And then also how revenue is to be recognised in accordance with AASB 15 and the 5-step approach. So, for example, whether it's recognised over time or at a point in time.
Thanks, Anthony. We've already gone 10 minutes over, so I think we'll close it there. Thank you, everyone, for joining our discussion today. There's more material, including publications and webinars on these topics on our website. So if you're interested, please have a look at that material if you have any further matters you'd like to look into, or please contact us if you wish to do so. Thank you.